hope it don't do that again. All right, so we having some technical difficulties, but tonight will be my first night. Every Wednesday, I plan to drop some gems, which is basically from start to finish of what the process will look like with before getting into a mortgage loan to actually going through the home buying process. And tonight, we're going over credit. We're going over credit because I have a lot of buyers and that reach out to me that wants to purchase a house. However, they have some things going on with their credit. So tonight I will basically be discussing some things, 6 steps that you could do to improve your credit score, because that's one of the most important aspects of getting approved for a loan. If you do not know me, for those that don't know me, my name is Ashley Poole. I'm a Coldwell Banker, a realtor in Atlanta, Georgia. This year I'll be celebrating 3 years of being a real estate agent here in Atlanta. Prior to, I was in property management for 10 years, and I needed something different. It was time for something different, and real estate was my go-to. So I want to disclose that the information that I am providing, I am not a credit or financial advisor. So the information that I'm sharing is basically from my own personal experience or from helping clients or family or friends. So it's based off personal experience or information that I researched and utilize myself. So no, I'm not a financial advisor or a credit advisor, so don't hold me to it. I just say research it and try it for yourself. The topic for tonight is 6 steps. We'll discuss to improve your credit to get approved for a mortgage loan. So I want to go over a couple of facts, and when it comes to credit and credit bureaus. So there's 3 credit bureaus that your information, your data is being reported to, and that's Experian, Equifax, and TransUnion. And they basically keep tabs on every person who has data being collected. So if you have a car note, all of that information is being reported to these 3 credit bureaus. Lenders use the middle score out of the 3. Jointly, so if you're married, they use the lower middle score from out of the 2. I think it's very, very important too when you're looking into improving your credit score and you're tracking this information, that you're using a credible source. So like for instance, Credit Karma is not a credible source. Like their algorithm does not give you accurate information. So that's one of the things, being able to connect and making sure that the information that you're retrieving is accurate and up to date, and it's not too far off from what things really, really are. Because that's the thing, some people, they look at Credit Karma and it's like, okay, well, I'm 700, I have a 700, and then they go and apply for a loan or something, and then they find out that they're like 450. So we want to be really, really cautious of that, so that we're A1 with the information that we're retrieving, so that there's no surprise when we do apply. When it comes to the information that is on your credit report, I don't know if you know, however, those things are on your credit for 7 years before they drop off. 7 years, they drop off. So some of you may look up with the fact that something may be on your credit for a long time period, and could be getting ready to drop off, and those things I wouldn't even concern myself with. So as far as the steps, step 1, pull your credit. There are so many people that come to me and ask me like, hey, what do I have to do to get a house? But they have no idea what their credit score is. You want to pull your credit. You want to pull your credit because, like I previously said, that is the most important factor of getting a mortgage loan. When you're talking to a lender, that's the main thing that they want to know. They want to know what your FICO score is. And if you don't know that, then you're going to have that surprise. you're gonna get a major surprise. So I would say always know your own stuff. Know more about your own situation before approaching a lender, so that you don't have that surprise factor, or you feel like, you know, down in the dump, and then you just don't want to try anymore because you didn't prepare yourself, or you didn't have enough knowledge of what you had going on. So just make sure that you're doing your part, your due diligence, and making sure that you pull your credit. You know what your FICO score is, you know what's on your credit report, so that they will be able to navigate you in the right direction. Okay. When it comes to lenders, like, in order to, I just had a situation where it was actually my brother. He wanted to look for a house, and I was just like, okay, I'm gonna go ahead and shoot you over to my preferred lender, and so we could see exactly where you are. So in this instance, he applies for the application, and she calls me and she's like, Ashley, I don't think I've seen this at no given time of my I just lost my thought. I've never seen anything like this before. And she was just like, your brother doesn't even have an inquiry on there. Like, he had zero, nada, no credit. And no credit is just as bad as bad credit. So I basically ran down the same things that I'm going to share with you tonight, and within a matter of 3 to 4 months, he's sitting at 737 as far as his credit score, based off the things that I assisted him with doing so that he could qualify for a mortgage loan. So the information that I'm saying, that I'll be sharing with you tonight, is legit, you know, because like I said, I've either experienced it myself with my client or my family or my friends. So for an FHA loan, you have to have at least a 600. For a conventional loan, you have to have a 640. So in order to get to that point, you have to understand that your FICO score is going to basically allow you to lock in an interest rate to get you in that ballpark of what your interest rate will be. And at the time, like, the interest rates are extremely low. They're starting to increase right now. However, they're at an all-time low. So the lower your credit score is, the higher your interest rate will be. The higher your higher your interest rate means, well, the lower your credit score, the less house you'll have. So you want to make sure that your credit score is A1, because you'll be paying way more than a person that had a 740 for that same exact house. Your income tells how much you can afford. It gives you your budget, how much you can shop for when you go out in the housing market. When trying to make repairs on your credit, or before going to a lender to apply for a loan, you want to make sure that all of the mistakes are taken care of. So if there's some things on there that shouldn't be on your credit, you want to make sure you take care of those things before going to a lender. You don't want to do it in the process, or right afterwards, because not unless it's going to be some time before you actually apply for the loan again. The average US score is 680. A score above 740 is a tier, which is the best. So the process in which my brother took within a matter of 3 to 4 months of getting to that 737, going from a 0 to a 737, basically put him at a credit score where he was at the best. And that's coming from no credit to establishing credit. FICO.com is considered a credible company. So like I said, to pull and run your information. Credit Karma is not one. I have used Experian for years. However, FICO.com they use a very similar algorithm that VantageScore uses, which is a company that the mortgage and the banking professionals use. So if you want to try to get as close to what your numbers really look like, then FICO.com will be a great suggestion. And as far as the basic, how much you would pay for their service is like $19.95. So it's affordable, so that you can get the accurate information that you need to get to where you're going. So we went over the first step. That's pulling your credit so you know what's going on with it. Step 2, pay your bills. Pay your bills. You have to pay your bills. Your credit report is your resume. It's just like when you send your resume in to an employer, they haven't seen your face yet. All they have is this information that you've provided and everything that's on your resume. And they can basically judge or get an idea of who you are based off of that sheet of paper. It's the same thing with your credit report. So if they pull your credit and they see all of this red, that means you're not reliable. You're not dependable. And that they're not going to trust you with borrowing money from them. So you have to pay your bills. You have to pay your bills just to run. And it's actually 35% of the credit factor, the credit score factor. There's a list of things that will hurt your credit. So missing a payment, being late on your mortgage payment, going delinquent on a student loan, going 60 days late on a car payment, ignoring a tax debt, going into a debt collections on a credit card, going 90 days late on a medical debt. So that's like a brief listing of some things that can have a dramatic impact on your credit, and that could turn things very sour for you being able to qualify for a mortgage loan. Step 3 is credit cards and secure cards. Credit cards and secure cards, it's not the same. When I recommend this, or when I have previously recommended this to people, they think that it's a credit card when it's not a credit card. A secure card is not a credit card. They're not the same thing. So the credit card is when you borrow money from a bank and you have to pay interest. A secure card is very similar. However, you have to put down a deposit, and you're basically like using your own money to build your credit. So using a secure card is actually a better route to take than getting a brand new credit card. Because if you get a brand new credit card, your credit score, if it's already low, is going to drop because it's a brand new account. So you can have an impact on your credit as far as it increasing, but because it's new, it's going to take a while. It's going to take a couple months before you can see the positive results of getting a brand new credit card compared to getting a secure card. And one of the best companies to get a secured card from is Capital One. And as far as credit cards, Capital One and Credit One, they are usually the go-to companies where it's easier for you to actually get a card from. But if you don't plan on purchasing within this year, within the next 6 years, I would recommend go ahead and get your credit card because it helps you build your credit. However, if you're trying to do something like this year, I would recommend that you get a secured card, to be exact. And with secured cards, they usually are going to request $200 to $300 as far as a deposit, just in case something happens as far as you not making your payments. That's the only that's a difference with, you know, getting a credit card. They don't ask you to put down a deposit. However, with a secured card, they do. Quick results. So with the quick results, you have the 2 secured cards, and then the other one would be to get 2 authorized users for a credit card. So if you know someone, and this can happen, like this will be a really quick impact on your credit, is being added as an authorized user for or on someone else's credit card. So if you have a relative like your grandmother or your spouse or your mother or your father, someone that you can trust, and they have a credit card that is being paid on time, like they have established their credit, they're good, it's A1. What I will say is ask them. Can they add you as an authorized user? And what will happen is what they have established with that credit card, you're going to basically be getting credit for it. And you haven't done anything. You're just being added. And they're going to send them a card for you. And of course, they don't have to give you that card. They can get it shredded, whatever the case may be. However, this is going to help you build your credit. And to have a quick response, I recommend 2. So 2 secure cards and 2 authorized accounts. And you have to make sure you could trust these people, because whoever you're asking to do this, they're gonna need your social security number. So you have to make sure that you can trust them, and you want to make sure that their credit score is good and that they're paying their bills on time, because it's going to reflect you. And with your secured cards, you want to make sure that you're using less than 10%. So you're not getting the secured card and just going to blow money. You're using this to get gas or to pay one of your utility bills, and by the end of that month, you basically pay that off. And it's going to reflect on your account. So you're with the secured card, not only are you you're receiving, or you're showing a strong pattern of paying your bills on time. You're basically showing yourself to be reliable and dependable. So you're building that pattern of being a person that pays their bills on time, so with this secure card. And that's basically what you're showing. Step number 5. So just to give a rundown, step number 1, pull your credit. Step number 2, you want to make sure that you're paying your bills on time. Step number 3, that you either get a credit card or a secured card. Step number 4 is getting an authorized user, or being added as an authorized user. Step number 5 is no big purchases. You don't want, if you're in a process of getting a mortgage loan, you do not want to go and purchase no furniture. You do not want to purchase a new car. You don't want to make any huge purchases, because this is going to impact your debt to income ratio. So if your closing is tomorrow and today you went out and purchased a car, you can show up to closing and be declined or disqualified for that loan that you knew you was approved for the last 30-some days. Now you can't close because you just went and purchased this car. So no purchases, because that adds to your debt. You don't want to do anything that's going to affect your debt to income ratio. The step 6 is don't change jobs. You do not want to change any jobs right before you're getting ready to apply for a mortgage, because you want to prove to the lender some type of stability. You know, most times they ask that you've been on your job for at least 6 months. They want to see some type of consistency, some type of stability. And if you have had a change within your jobs, that it's something that's within the same field, same industry, similar pay. You know, it's just with a different company. That's easier to track your income compared to you going from being one thing to a truck driver to somebody who works in a warehouse. Like, it can't be completely night and day. So you want to stay in a similar field. So those are my 6 steps. Run them again. Pull your credit. Pay your bills on time. Get a credit card or a secured card. Get added as an authorized user. No big purchases, and do not change your jobs. If you have any questions, please DM me. Give me a call at 678-613-4895. I will be hosting a live every Wednesday on different topics, which is basically from start to finishing of becoming a homeowner. So if there's anything that I can help you with, just know that I got your back, and you can hit me up at any given time. And thank you all for tuning in. Share with your friends, share with your family, and see, you know, if there's anybody else that this information can be good for. Peace.